Hi there, welcome to the channel. I haven't done a stock update in a little while, but I just want to look at some things here that happened last week. I think let me just try to go back to the main indice here. Um, so if you look here, we're in this daily chart, about 1 year, 6 months, something like that. We can see we're in this uptrend now. So the S&P 500, just had another strong run. It's just continuing to press up. And if we look at the weekly on this thing, we see that we're just continuing this uptrend going up here. S&P is this charging along. Dow Jones Industrial Average, had a strong week last week, breaking out to new highs on that. And let's see, did the S&P 500 break out? Yeah, it broke out too. So you see that just the wide-ranging averages kind of broke out. Let's look at but the NASDAQ kind of struggled. So the QQQs, NASDAQ struggled here. They did sell off, but then recover a little bit later in the week. It definitely, there's sort of a lagging, and this sort of goes with that kind of that trend that the high beta stuff is kind of struggling. So let's look at just kind of what interest rates are at. You can see that, we had some moves in interest rates last week. And this, of course, is really the debate. It's related to inflation. If the inflation kind of goes up, at least from the kind of maybe the investor point of view, if inflation is going up, or you expect higher inflation, then you kind of need higher, interest rates. Because for example, here, this is, these are, currently like 1.5%. So you shift the decimal to the left by 1.5% yield on the 10-year. And, basically, so let's just make the math really simple. So let's assume this is at 2%, but if inflation's at 3%, then what's your real rate of return? You have to take the 2% minus the 3%. So what are you left? What is your return after accounting for the loss of purchasing power from inflation? Then you're at minus 1%. So when you look at things, it's very likely that we're somewhat in, negative yields on the 10-year at this point, meaning that you're losing money. Now, you're not losing money like nominally, but you're losing purchasing power. So it's called a real rate. Your real rate is the return when you factor in inflation. Of course, it's all very fuzzy, because what's inflation? It's like there's many different measures of it and much debate about it. But if you look at this here, it's really interesting. So on the 10-year here, this was quite a day. So this was really, that's kind of a messed up day. So basically what happened here, basically the yield dropped off a cliff and then it came back. So what that means is, there was like heavy rotation into bonds, a bunch of buying, and then they like basically sold them off. So it leaves this hammer, and so it will be interesting to see what happens here. So really on that day, so I forget what was happening on Friday, but obviously something happened on Friday. Oh, it was the jobs thing, right? So, okay. So yeah, that's right. So the jobs report, they were expecting 1 million jobs added. And yet there was only like 250,000, something like that. So it's a really big miss on the jobs report. So I think just trying to, one thing to kind of note about the jobs reports is that there's a bunch of different ones. I think that, if you're not really that familiar with it, there's just a bunch of different job reports, and you can get into the technical details, but you have the, you have the weekly. So you have weekly jobs are reported weekly. And these are through BLS, I believe. And weekly you're getting basically called new claims, and this is what we've been seeing a lot. So the new claims numbers are being reported weekly. All right, and then you get this monthly jobs report, and that's the one that just missed on Friday, and kind of caused all this consternation. So that's done monthly. So the thing is, it's like they don't necessarily completely correlate. Weekly, you're looking at two different things. You're looking at basically how many initial claims were filed, and on a weekly basis, unemployment claims, right? So you have the unemployment weekly, how many claims were filed, and then continuing claims. So that's reported weekly. And then on monthly, it's done from a entirely different survey and everything, whether, how many jobs were created for the month. So they don't always have to correlate. I mean, there should be relation between them. So given the weekly reports that we've been having, it's kind of not surprising that we had a bad miss on the monthly, but it's just yeah, I don't know what to think of it, but let me look here. Let me look here at the so we have different things going on, like I'm talking about. We have initial claims versus the monthly unemployment. So that is calculated different ways. So if we look at the initial claims here, we see that we have, after cerveza sickness, we had this massive spike in unemployment claims, and it's dropped off. But what you see is it's kind of been persistently high. Before, over here, 200,000, just for years, you see 200,000 weekly claims, something in that range. And now we're still kind of persistently holding around, we're holding around, call it around, 500,000, something like that. And that's where we're at right now, 566, whatever, 498. So we cracked 500. So I guess the good thing is you can see that it's dropping off a little bit. Maybe it is getting a little better, but it's just taking a very long time to recover, very long time. So, so I guess that was a surprise for the market. So I guess then what happened, why it happened, who really knows, but basically some bot or something, or some investors must have thought like, oh gosh, the market's going to sell off really bad, and they just ran into bonds, and that's what caused that. It's kind of surprising because, like, if I look at the SPY, I mean, how far did the market didn't even move down on that. So that was kind of interesting. So why did yield spike a bunch of money, like run into bonds, driving the yields down? I don't know. It's a very weird day. It's almost, when you see these kind of things, they're almost like flash crashes, as if the system broke a little bit. There was a disconnect. So yeah, so that's kind of really interesting. So kind of that's what's going on, I guess. So where in the market, what are we looking at? So what I'm looking at, let me just kind of see, I have, like, as I have a significant position in just like the overall indices. So what I have is this hedge, and this hedge is this ProShares Ultra VIX. And the reason I have this is I'm trying to, like, if things should go to the trash can here. So like what happened back here, you can see that you get this spike. So when you have these problems, you get this spike in this thing, and that's when I'm trying to buy that protection. You see these little tiny things here, but they're not really, it's sort of not becoming very effective. So I'm taking, significant losses here. This thing is that's going to, now it's a small part, right? So it's basically a hedge. So it might be one, like a 2 to 5% position that I'm holding to try to have some kind of a buffer if this occurs. So it's a known negative carrying cost. So that's one of the things to keep in mind with all these type of like short and ultra short funds. They do have a negative carry. So over the long term, they're always going to be dropping. They're always going to be going lower. So what that means is there's sort of like an option. You have to get the timing right when you buy them. Now here, so what I'm starting to think for me is I got to look at this and see if I need to have a better hedge here, because maybe this is costing too much money, and maybe it's not going to give me the protection I want. Maybe it worked really well here for this particular case, but maybe it's not going to work. I don't know. So I need to look at that. So that's one thing. Kind of going a little bit of confession on that. And then XLP kind of still just doing good. So kind of If you're in the right stuff, if you're in more wider, just general market stuff, you're okay. But if you're in the high beta stuff, you struggle. So like, let's look at Tesla here. So here I had tried to get in and really didn't do much. But we can see here we have this W going on. And it just, as of this point, we had this W, came up, did this stuff. Now it got above the 50. So that's where you're kind of like, okay, it got above the 50. But it really, see here, it just never really could get any momentum. Then it came here, we have another strong day. You have a strong day, but then it's followed by a really weak day and it just loses the momentum. And then here, this is like a bullish type engulfing day here, right? And then it just loses the momentum. So this thing is just not able. And interesting, like if you look at that day, it had okay. Okay. Let's do this just a minute. Annotate. Yeah, so on this day here, like the volume was up pretty good too. This day here, not really great volume. And then this day here, you had the volume. So you had some days where you had accumulation days trying to put in a big bar, but it just hasn't added up. So I don't know. I really don't know. But here's what I'm thinking is and this is not financial advice, but from my point of view is I'm kind of looking at these guys. I'm looking at like the Teslas of the world. I'm looking at the EV plays, the Neos, all this stuff, the Enphase, all this, basically, let's call it what it is, the Meet Kevin stocks. I'm looking at all these and I'm really looking to see if these guys are going to like form in a base and then, potentially set up to have a run because, they kind of have gotten beaten up. Some of these have been beaten up, so much that, they've had a really good pullback. Like if you look at, so we take Neo and we look at this thing like, we are on the log scale there. So let's take that off for a minute, just so I can read the numbers here. Okay. Yeah. So we look here, this thing was up in 60 and it's at, 40. So, you're talking about whatever you call it. It's like a 40%, something 30, 40% drop. So significant drop in that. And then if you look at Tesla, I don't know, pick a number, 900 to 600, another 30 to 40% drop, depending where you measure it, right? And then if we look at RK, Woods, like she's kind of getting beat up 160 to 100, it's probably, I don't know, 40, 50% loss, So, this whole space is just getting the crap kicked out of it. And, it's kind of feeding on itself. It's a little bit of a doom vortex. If people are selling ARK and ARK is heavily invested in some of these EV plays, and that could be the answer. So the big picture is, what am I thinking? I'm just trying to watch them. Like if some of these things start setting up somehow, if somehow these things start setting up, putting in a base and start reversing, then, I certainly will take a look and consider buying them because they definitely, like if Tesla can deliver on what it's supposed to deliver, there's definitely a good argument for it being much higher, of course, But the problem is if they can't deliver or if the economy doesn't do what the economy needs to do, that's the part that I think, excuse me, that's the part that I think like a Meet Kevin and stuff maybe doesn't understand. It's like, well, the problem that you have is that, you have to believe that everything's going to be okay and there's going to be no problem. So, basically if you listen to the Kevin dude, his bet, really, the thing is, his bet is that inflation and interest rates as well, but inflation has to remain low. And yes, he acknowledges that it's transitory base effect and all this kind of stuff that, okay, it could be. I mean, it could be transitory. But what if it's not? Then if it's not transitory, if things really do change, then he's going to be in a world of hurt because, these companies like the Teslas, whatever, they need to raise money. They always need to raise money. It's so funny, that guy, Tesla, I mean, they've raised so much money at different times. I'm not saying recently, but they just come out like, oh, 500 billion in stock, whatever. And they always need it. So because they are heavily investing, which is fine. But if the economy does eventually take a hit, then they could just be in trouble if the growth isn't there. I mean, right now, like Tesla, like the big thing is, can they meet the production needs? And that's the main thing. That's the main thing they've struggled. But what if the demand isn't quite there? What if the competition gets in? What if they have to give up margin to keep the sales up? All these things are sort of the unknowns, and basically you're betting for perfection here. And so we'll see what happens. But in spite of that, I'm looking for a setup, because if there is a setup, I'd take it, because they could have a move. And like I was saying here with like Tesla, man, it really worked really hard. It really tried. In many ways, like it's maybe one of the strongest ones in this space, because I mean, the fact that it tried to pull out, it tried to break out, had these strong days, some up volume days on it, but it just overall, it just couldn't quite make it yet. So if you look at this absorbed a lot of negative energy. They try to just knock it down, but it was unsuccessful. So let's go take a look at Dogecoin. I don't know what people thought. I mean, did you think that Elon being on there was magically going to make Dogecoin go up more? I don't know. What was he supposed to say? I mean, I don't know. It's all speculative. It's amazing how things are really just kind of weird like that. But so here you are, the 1 week. So it looks, Dogecoin getting the crap kicked out of it. So, yeah, just look at that chart. So it's just, kind of double topish, right? But, it's just so overextended. And then you have this longer term uptrend here. So like if I go here, let me see if I can go here, and I'm going to annotate, like, and do this. And yeah, so you sort of have like this longer term uptrend here, right? See that? And so when you look up here, it just got way overextended, and now it's pulled back to that average. So, it wouldn't surprise me if this thing does keep working its way up. I mean, it's back to the long-term average. Here, same kind of deal, just so extended from the moving average. And then it came back down, but in this particular case, it just kept riding the average, still started making progress. So, I mean, we'll see what happens. The fact that how overextended it was here is kind of like, yeah, it's pretty overextended and all that. So, maybe it'll have more to the downside, but who knows? Who knows? You never know with this stuff. But this is pretty typical. It's typical behavior, and something to keep in mind when things are extended beyond a trend line or a moving average. And this is why I sort of like these charts that I have that, if I look here, let's say, let me get rid of all this, clear this, and it'll go like that. Yeah, so that's why I kind of like using the charting where it's kind of fixed. Like I'm not zooming in, like pinching in and stuff like that. So I have these fixed kind of x-axis. So I know it's kind of silly, and yes, you could do log or non-log, but it kind of gives you an idea about how quick things are moving up, right? You can kind of look at it and kind of, say like you're looking for that 45-degree kind of angle off to the right, something that's sustainable, something that's, riding up not too far from the moving averages, because it's more sustainable. If the more things get extended away from that moving average, they just become, unstable. And their risk, there's a risk of them pulling back. So if you see here, so for example, looking at this Tesla chart, weekly chart going, here in this period of time, look how far, look at this distance, look how far this thing comes away from the moving average. And this is the 30-week moving average, the 30-week, 150-day, blah, blah. It's like, kind of like a 200-day moving average-ish. I use a 30-week from this guy, the guy from the 80s, one of these guys, I forget the guy's name, but a really good book. And he does all this trading on the weekly stuff long-term. But so it's a really good book to read. But I forget the name of it. I'll look that up. But yeah, so that's why I use that one. And it's all very similar. It's all about the similar to the 200-day, et cetera. But as you get so extended, the point is, your risk to pulling back. So if you're accumulating a lot, and you're accumulating a lot at these points where you're away, you're always struggling, because if you want to deal with psychology of trading, here's the thing that you have to understand about trading psychology. Okay. Trading psychology isn't about like, you don't log in to see what your thing is, it's not denial. You can't, my opinion is you shouldn't deal with the problems of trading psychology by being in denial and not paying attention to what's going on. You have to, it's like you kind of have to have strategy, and you have to do the right thing. You have to buy it right, and you have to avoid not buying it, wrong. And so, for example, here you have, like, down here. So let's look at Tesla on this weekly chart. Here you have basing, down in here. So in here, you're getting into place, even if you're wrong, you didn't buy the breakout of this point here, and you're still a little bit wrong, you're getting at a point where somewhere in this breakout, is a place where you can do some buying, right? But now as it gets too extended away from this area up in here, now you're just at risk. You're going to take that loss. So now here, if you're buying out here, 150, like this price point, is up 150, 200. So if you're buying up here, you're going to take a 50% loss. Look at that, 150 down to 75. But yet nothing really changed in the big picture of the stock, right? Right? Nothing really changed at all, right? So, so that's kind of, why is my, oh, I see what I did. I draw. Okay. Draw. Hello. Yeah. Draw. Okay. Is it drawing? Okay. Yeah. So really, when you're talking about dealing with psychology of stock trading and stuff like that, the biggest thing that you can do to help yourself with that psychology is try to buy things correctly. You want to buy something that's a higher probability play, and that's how you want to do it. Because if you do it and you buy somewhere in here, yeah, it goes up and you're all excited about it. Okay, fine, but you're not buying more. And then, it goes all the way down to here. Well, look, you're back down to like break even when it finally catches the moving average. See, how do you deal with the psychology? You're dealing with it by understanding the technicals, right? All right. So you like, the reason you might be buying the stock is because of the fundamentals. You're like, oh, the growth, the prospecting growth, et cetera. Okay, so this is Investors Business Daily. That's like what they're all about. They're mixing and blending the two, right? They're mixing like what has the potential for the highest growth with the technicals, like when you try to buy. I mean, it's the best type of strategy to deal with things. So if you're up here and you're trying to, and the problem is, like, here's the thing. So if you're buying here, like I said, you're going to take a 50% cut, and nothing really changed. It was still a great setup for this thing to like follow this run, and you don't want to get shaken out, right? You don't want to. Now, if you had bought down here on a proper breakout, then you're less likely to get shaken out, right? So the problem is, like, is this all, or are you being baby hands? Well, if you're up here at 150 and you just lost 50% on that position, you can't have many of those. And the reality of the situation is, hey, you lost 50%. Well, there's not, yeah, this ends up being Tesla, like a big winner, but there's like, for every Tesla, there's 100 other stocks that, like, no, it failed breakout and goes down, and it goes down another minus 50%. And then they go to bankruptcy, right? So you don't know this, and you can't know this. So you have to have a strategy that deals with it. So if you're here, you had bought a breakout, it comes down, and you're like, oh, even here, you might still be up, or you might go a little bit negative. You're like, okay, well, now the technicals, like, well, it's at the moving average. If it doesn't find support here, then yes, I'm going to hold on a little bit. But if it doesn't find support and it starts going down more, I'm going to have to sell, and I'll take a loss, a 5-10% loss. But I'm not going to take a 50, 60, 70% loss. So you can see that your psychology is driven by the behavior. You're setting yourself up for pain and difficult psychological decisions if you buy things wrong and you don't manage them correctly. You have to, it's like, I guess the best example I can give you is, like, if you're sitting there on a windy day and you're pissing into the wind and you get wet, right? Because your pee blows back all over you. Gross example, right? But imagine if you pee into the wind, but the way it is like, you won't get hit by your pee until 3 months later. So you just do it, and you're like, oh, I can do this. No problem, no worries. I can just pee into the wind anytime. Look, it doesn't come back at me. It's like, no problem, right? But then 3 months later, all of a sudden, you get hit with pee. Like, where the hell did that come from? What happened? So you can see that's exactly what happens here. You do a decision over here. Let's keep in time. Here you bought this October. Here you are. You're celebrating Christmas, whatever. You're like happy. Come around February, March. This is like 4 months later. It's like, oh, really good. And then over here, so you're talking between here and here, you're talking almost 6 months. And then if you had bought it up here, it's like 2 months later, you're getting your ass kicked, right? You're getting your ass kicked. So that's the point. That's why, when I look at charts, I do so much on a weekly chart, because it does matter the big picture. I mean, I don't do much on a daily chart, because if you're, it's really hard. It's like, okay, let's talk about psychology of trading. Like, okay, if you're gonna trade stocks and you're doing numbers on stocks going 2, 3, 4, 5 years out, then why are you looking at the daily chart? That's kind of silly, it's kind of silly. So yes, I'm trying to say that you deal with difficult trading situations. You deal with them by not denying them, right? You have to face them. That's the first thing. But on the other hand, you're not in denial to not focus looking at the 10-minute chart every day. The 10-minute chart is just too fine-grained if you're dealing with weeklies, right? So yeah, those are my thoughts on it. So I don't know what kind of things people are saying out there, but I just see some really bad advice by people that are too young to just have gone through it. They don't understand. It's like, the Fed has, if you look at the QQQ, and you go back in time, and you go back to 2000 here. So if you go back to 2000, now looking at these numbers, I know that people are like, well, that wasn't that big a problem. No, it was a huge problem. This is a huge run. So if you look at the QQQ and you look back here, so this is in 2000, you had a run and this thing was going up the entire 90s. So I don't have as much data in this particular chart, but trust me, it was going up. But then you just go to this hyperbolic phase. And once again, if you were buying anywhere in here, you're set up to get your butt kicked, And so here, technicals, really big outside weekly days and stuff. And once again, if you're buying up here, it took a long time to play out. This is a whole year. This period of time is 1 year. This is 1 year, right? So that's a long time. So, you hear it beats up and then it finds a base and then it's going in a range. It's very kind of range-ish, wedgy bound, and then it broke more to eventually end up down here. And all these numbers are smaller, but keep in mind, if you were buying up here at 100, this thing hit is 10, 20. You're talking about 80% losses, right? You went from 100 to 20, 100 to 20. And although it does recover, this took 3 years for that to play out. So, that's the thing. It takes 3 years for that to play out. So it's all about, once again, it's like, it's how are you psychologically going to deal with this? Like, if you're doing it wrong, if you're being impatient and buying at the wrong time, you're going to cause a problem for yourself. So looking at silver, I wanted to look at this here. We see that we go to weekly chart here. Yeah, silver, see, it had gone up here about a year ago, and then it kind of bounced around. It's been in this trading range, but look, it's starting to pick up right now. So it's kind of interesting. So the silver, I'm kind of interested in that. That may be one that I may be making a trade on because it's starting to pick up and break out of resistance here. So if we look at this, try to get, obviously your big resistance is up here. So, well, let me do this. Let me just go back to, let's go to a little bit longer chart. Yeah, let's go to the 6 month and let's kind of play with that guy. Yeah, so we have resistance kind of here in this range, right? Somewhere there. Now, yeah, resistance here too, but that's just such an outlier day there that it's kind of like, I don't know what usefulness we get out of it. But this orange line is a 200-day moving average. So it kind of came down into the 200 and it's starting to break out from like this nearer term resistance. You look at this areas here, near term, you know, you have some resistance and you kind of, it's sort of almost like an inverse little head and shoulders, but you know, those patterns are not that useful, I think, especially like this, because it's really just a consolidation period. You know, you're kind of moving around in this big area. And sure, you might have like a little neckline here. This might be like a little head and shoulders, and we've broken above it. But I wouldn't put much stock in that. But just the point is, it's starting to make a move. It looks to be making a move, kind of breaking out. So that's one that kind of be looking at. So if I go back and let's go to the weekly on it. So you see in a bigger term, it had this big move back last year, and then it just kind of went sideways. It's actually really like in a range. I mean, it's had some movement, but you know, it's kind of like some kind of a, you know, a big range, you know, it's kind of like been in this range for like a year or whatever. And now it's starting to cycle up. So we'll see what happens, but that's kind of interesting. That's one I'm looking at too. Gold. I mean, gold should be gold is this, you know, it was more of a downtrend here. And so now it's trying to peak out above the 200-day moving average. That's going to be the 200-day moving average there approximately. So it's starting to peak out. So if I draw some trend lines here, let's see what's going on with this. I mean, the trend lines are kind of hard to draw here. It's not perfect, but we can, yeah, you know, it's not great. It's not great, but we can kind of say like, look, you kind of have like a channeling down, kind of a channel. And, you know, it's possible that it's maybe going to pop out of this channel. So that would be kind of bullish for gold as well. So that's interesting. That's something kind of, and that sort of points towards the inflation, right? And then let's look, here we are in the weekly chart. We're looking at the dollar. We're looking at the UUB just as a proxy for the dollar here. Yeah, so this was kind of interesting because what had happened here, you know, we had this big down move. And then, but down here, we, you know, basically started to have this, if I go here, yeah, let's just try to do this. Yeah, so we basically, I think I was pointing out, like, we kind of have this kind of megaphone pattern, but the point is, ignoring patterns, etc. What it's kind of doing is, it's, you know, it's basically reversing, right? You find a low in this point, and you know, you're starting to come up and you're starting to cycle up. It's going like this. But see, then it kind of broke to the downside this week. So it's kind of significant week because it really broke to the downside, and now it's at this you know, low from earlier. So if I go and I clear all drawings, stop that, and let's go to let's see. I want to go to a year chart. Yeah. So we go to the chart, a little bit more focused in chart. You can see that yeah, you had a low here. Okay, just do as I ask you to do, please. Okay, so you had a low here, but now, so in general, like really simple technicals in terms of not patterns, but you're putting in higher highs, right? So here you had put in a low, and then the low over here was higher than this one. So and then your high, you're starting to get a sequence of higher highs and higher lows, right? And then, but then what really happened, and we kind of were stalling, and you know, we kind of really stalled at this area here. And then you had this big day, and then it just reversed last week, and you got the crap kicked out of it. So this really broke this kind of issue of finding higher highs and higher lows. Now, technically, right at this point is still a little bit higher. So maybe if it reverses, it will put in. You know, if it reverses and goes up like that, maybe it will. Maybe it will technically be a higher low. But the extension of this, in the fact that it came down and it turned up and then rapidly failed, that kind of is sort of very bearish for that. So the dollar really got hit. So that kind of makes sense, I guess, that silver and gold are kind of popping up here because the dollar really took a beating. So once again, I have no idea why, but I think that that also points to a sort of the inflationary type of thing, because the problem is, if inflation is, there's two things, right? Inflation could be from, printing money and putting dollars out there. You put more dollars chasing the same amount of products, pricing goes up, that's inflationary, right? The other thing that you do is if you have the same amount of dollars and you have less product and services out there, then you have same situation. You have same amount of dollars, but chasing less goods and services. So it has the same effect, more dollars chasing less goods and services. But then the other factor is that, this kind of, produces weakness in the dollar. If the value of the dollar is going down, that's sort of inflationary as well. So you can imagine for anything that we import. So the way this works is if you take a dollar and, on the international market, like we're really lucky right now in that we, oil is traded in dollars, right? And so that really saves our bacon, because the fact that oil is traded in dollars, people need to transfer to dollars. So if you're in a euro or something like that, or you're in a yen or whatever it is, and you want to buy oil on internationally, you got to go get dollars first and then take those dollars to go buy oil, right? So that's how it works, right? So this creates artificial demand for dollars. Now, when the dollar is weakening, so this, it's all relative. So this dollar weakening is relative to primarily the euro and some other currencies, euro, pound, and other various world currencies. It's sort of an index, right? But, the dollar going down is actually points to inflationary for us. And if you do currency trading, you realize there's no absolute. There's not like an absolute measure. Like most people think of dollars as sort of an absolute measure of what something costs, but that's not really how it works. Like if you're trading currency, you're trading a pair. You're trading dollar, euro, dollar, yen, whatever. You're trading, a currency pair. You're basically always, when you buy one, you're selling the other. And so that's kind of the issue. So the dollar going down is also sort of points towards sort of inflation, and it points to domestic inflation as well. So although we're fortunate in dollars priced in oil, there's other stuff that we, potentially do need to import. And so if the value of the dollar is going down, what you'll also see, when you look at the dollar going down, what's going on with other things? Well, what's going on with oil? So let's look at oil for a minute. So now if we look at oil, we're just going to look at USO. It's not perfect in any way, but oil has been going up, right? And if we compare oil to the dollar, and we divide these two, what you're going to see is this kind of a thing here. So basically you can see it looks like the oil chart, because basically oil and the dollar loosely appear to be sort of inversely correlated. So you can see USO is the chart. USO is the candlestick chart here, right? So you can see here, if you look at this, you can see that here's the candlesticks, right? The candlesticks. So here you see oil pricing going up, right? As you see the dollar, right? The dollar is the black line here, generally going down. Now the dollar tried to make a move here, like we were talking. Dollar tried to make a move, and then it just broke down. So it's not like they're inversely correlated like 100%, but you can kind of see the pattern. You can see this general trend that, downward pressure in the dollar is going to put upward pressure on the price of oil. Now, why is that? Because oil is priced, a barrel of oil is priced in dollars, right? So, if the thing you're using, the dollars, if the value of that, if it requires more, so if the oil goes from $30 to $40 a barrel, then that tells you that what happened? Did the price of the oil go up, or did the value of the dollar go down? It basically is like physics. If you look at like general or special relativity, it's like you can't tell the difference, right? you can't tell if you're in an elevator being accelerated or if you're on Earth, right? That kind of experiment from physics. So they're all relative to each other. So as the dollar, pressure on the dollar down indicates, pressure on the price of oil to go up. And, what's really happening here is the oil price going up or the dollar going down? Well, what's really happening is that the barrel of oil, conceptually, the barrel of oil is just the barrel of oil. It hasn't changed in terms of what you get from a barrel of oil, et cetera. It really hasn't changed. There's no change on that. There's no delta. Okay. There's no delta on it. So you're just looking at it. You're just looking at, movement in the dollar and movement of the price of oil relative to the dollar. Now the price of oil can change due to supply and demand on it. But there is a factor. You can see right here clearly there's a factor between dollar and oil price, and that's because dollars are used to price oil, at least for now. And if that changes in the future, that's going to have a big effect on the U.S. So yeah, that was one other interesting thing that I observed. So so I think that's it for this one. Talk to you later. Bye.